Why are student credit card interest rates so dangerously high? Imagine getting a credit card as a student and thinking it's a quick way to buy what you want. But then you see the interest rates and realize how costly it can be. Student credit card interest rates tend to be high mainly because students are seen as higher-risk borrowers by credit card companies. Since many students have little or no credit history, lenders can't easily judge if they will pay back on time. To make up for this uncertainty, they charge higher annual percentage rates, often around 18% or more. These rates are much higher than those for people with established credit. Some student credit cards start with a 0% introductory rate for a few months, but after that, the rate jumps to the regular high APR. This can be between 17% and 26% or even higher. One big reason for the high interest rates is that students usually don't have a long credit history. Without a track record of paying bills on time, lenders see them as more likely to miss payments or default. Students often have lower or irregular incomes and less experience managing money, which adds to the risk. Because of this, credit card companies charge more to cover the chance of losing money. Market and regulatory factors also play a role. The overall economy affects interest rates, including the rates set by the Federal Reserve. Since the average credit card interest rate for all consumers is around 20% or more, student cards tend to be priced similarly or a little higher to compensate for the risk. Some credit card companies offer student cards with rewards or perks to attract young users. But they offset these benefits with higher interest rates to make sure they still profit. For students managing their budgets, these high rates mean that carrying a balance can get very expensive. When you don't pay off your full bill each month, interest compounds on the unpaid amount. Even small purchases can grow into large debt if not paid quickly. Nearly 65% of college students carry credit card debt, and many don't pay the minimum amount due. This creates a dangerous cycle of debt that can be hard to escape. To avoid falling into this trap, students should use credit cards mainly to build credit and pay off the full balance each month. Understanding how the interest rate works and how interest is calculated helps prevent surprises. It's best to avoid carrying balances on high-interest cards and to look for cards with introductory 0% rates. Keeping track of spending and making payments on time should be part of your monthly budget. In the end, student credit card interest rates are high because lenders see students as more likely to miss payments or default. This higher risk leads to higher costs for the borrower. Staying aware of these rates and being disciplined with payments can help you avoid costly debt and keep your finances on track.